Hello and welcome to Crypto Weeklies. In this video, we analyze the crypto pairs. None of the content financial advice. This chart and all the charts are available on cryptoweeklies.com. Link on the bottom of your screen. You don't have to pay for anything or signups or anything. This is the crypto pairs side of things. We also have the USD side. Today we talk about the crypto pairs starting with two galaxies over here in the galaxy view. The first is Bitcoin Galaxy view. The second is ETH Galaxy view. The hypothesis of this Lagrangian Galaxy is that the relative distance between these crypto and Bitcoin is it's not an indicator of these assets decoupling or being gravity pulled towards Bitcoin. It's just an identification of the composite risk with respect to Bitcoin. The closer these assets are to Bitcoin is again a reflection of their composite risk, whereas these color codes over here, the accumulation, the stable, the lagging, the overextended, and the bleeding sink, is an estimation of both their return and the risk. The zones are as follows. So for example, accumulation is anything which has, based on the machine learning based models that we grow on sites, such as the forecast graph, the composite growth forecasted by the mean forecast of the 23 weeks or the next 6 months is greater than 5%, risk is less than 50% or 0.45 to be precise. Lagging are the ones you can see that ETH BTC is in here, where the forward looking return projection is negative 9%, which is again slightly negative, but not too much of a bleeding sink, where the return is greater than again 5% and risk being greater than 60%. The risk with ETH BTC pair is relatively low, and what is also good with respect to this is the mean reversion pressure right now is less. So that means if you analyze this pair, this number of Bitcoin available for 1 ETH, it's again trending down since that August 2025 high that ETH enjoyed against Bitcoin. Now it's kind of falling down in that base trend projection over here. In the next 6 months is that lagging parity. Nonetheless, if we have again a one standard deviation bull case or a bear case with respect to Bitcoin, then these are the ceilings. So this is how much ETH could grow in the next 6 months or fall down in the next 6 months if this trend were to have any major bearish bias or bullish bias. So this is one model. The second, or arguably more important model, is the time weighted average price model. This blue line over here is the time weighted average price line. This helps identify the baseline value that ETH has created, not just on its USD pair but on its Bitcoin pair. So that's a reflection of how much of the fair value or the baseline value ETH has had built through years of trading with respect to its Bitcoin related valuation. And this is color coded from and with gravity levels from 1 to 10. The lower the levels, that means ETH at those levels is typically undervalued with respect to Bitcoin based on the time weighted average price value. Right now, this time weighted average price value is not in the lowest area, but again, it's at level 2, which is again typically anything less than level 2 or level 3 is typically where ETH is not overvalued with respect to Bitcoin in a longer term price horizon perspective. Nonetheless, again, as this is not at level 1, that's why it's not in accumulation territory. It's in this lagging territory, the lagging dilutive parity territory. The valuation bands are this ETH valued against Bitcoin. Whenever this falls off the cliff, right now it's in this accumulation territory, that is one standard deviation, this olive area over here. The deep discount or anything below the deep discount is when the moves are greater than 2 standard deviation or greater than 95 percentile moves. 95% of the time, the valuation stays within the confines of these bands, and you can notice that the bands are shrinking in size to account for diminishing volatility. This helps identify, so for example, the move that ETH made against Bitcoin in August 2025, that puts that move in perspective and helps account for that diminishing volatility, to say that again, the likelihood of ETH making a new all-time high against Bitcoin goes down with time as much as ETH enthusiasts would like that. Just by the virtue of ETH not putting a new all-time high against Bitcoin in the last two bull runs, not just in 2021 and in 2024, but the last all-time high came in at 2018. So again, this accounts for that valuation slide. But still, again, that doesn't mean that ETH can never grow or be a profitable trade. Again, not financial advice, but again, if the hypothesis is that this oscillates between the blue end to the red end, accumulating at or near the blue end and then distributing at yellow or red depending on how the bull run pans out. The last time around there wasn't a major alt season, that's why ETH never went to the red zone. With respect to Bitcoin pair, that is a clear-cut deviation from the last two bull runs. One could also say that this is just accounting for diminishing return, and the next time around this valuation could peak at around that fair value line or something, but that is a bear case. The SMA interpretation, or the 20-week simple moving average, the 100-week and the 200-week simple moving average, helps identify and create the cumulative risk score. Anytime this falls below the dotted green line, that is typically in accumulation discount territory, like it was till about that May 2025, April-May 2025 downturn that ETH had severe downturn against Bitcoin. Since then, again, although ETH has been trading down with respect to Bitcoin since August 2025, it hasn't gotten into that accumulation territory yet from the SMA model. The gravity profiler is similar to the time-weighted average price model. It's just slight different interpretation of, rather than looking through the gravity-based level, this looks at a risk-based level. It's one and the same, more or the less. It's just trying to better visualize it. And again, right now for this model as well, ETH is in risk level 2 or gravity level 2 at this point. Again, at some point we'll probably collapse both of these models together. Now looking at how these zones kind of matter overall, as these tiers kind of shape up right now, the stable ones are the ones which are again at neutral territory. For example, BNB over Bitcoin and Link over Bitcoin. And you can see that from the composite risk perspective, in this territory, the composite risk with respect to Link accumulation is 0.52, whereas BNB comes with a slightly higher risk. The reason for that could be, again, a relative stable series of lower lows and lower highs for Link. Time weighted average price in terms of Bitcoin valuation is at much lower territory in risk level 1. Gravity risk is only 0.1. Valuation band has more or less, again, not been that helpful for Link at this point. The SMA valuation is again at the midpoint of between the overextended and accumulation territory. For BNB, the same can be said that it's actually making a new series of higher highs and higher lows, and the forward projection is slightly bullish. Nonetheless, the time-weighted average price based valuation is much higher. The time-weighted average price risk is more because the price is, again, the valuation is higher than the time-weighted average price. That comes with its own sets of challenges. And again, this valuation model has actually said that the price is in this bullish territory. So that's why, again, risk is slightly overvalued. And again, with respect to Bitcoin, it's overextended. The typical overextended, if we kind of blow this even more out of proportion for Tron, which has right now a 42% increment with respect to Bitcoin valuation forward projection, composite risk is 0.86. This has been in a major uptrend since 2021. Tron has, again, on its Bitcoin pair, has only seen bullish returns. This is, again, now it has returned into that 0.7 to 8 risk on the gravity risk. The valuation bands are also in this red, almost at the red end of the overvaluation or overextension zone. That has created a higher risk of mean reversion. By mean reversion, it means the likelihood that the price action comes and visits this fair value at any given point. The SMA risk is also in overextended territory, as the price is above the 20-week, the 100-week, and the 200-week simple moving average. These averages, and again, the overextension is at around 0.96, so almost coming in at that level. The other interpretation of this galaxy is, again, as the bleeding sinks would have it, it's typically the mean reversion pressure is lower, but the composite risk is greater than 0.6 as mentioned, and the return is greater than negative 0.5. So for example, ICP over here. Similar analysis for ETH Galaxy helps find different sets of winners with respect to ETH is again Sol and Doge. Both are in accumulation. That means from a forward projection perspective, Sol has had a greater potential since that short-term bottom against ETH in May 2026. The time-weighted price model also has price has been building that gravity baseline and ever increasing gravity base time weighted average price line against ETH. So this is again a difference between Sol and Sol on its Bitcoin pair versus ETH pair. So on its Bitcoin pair, Sol is in this composite risk of 0.43, forward return of positive, projection of a positive 8% return, and mean reversion pressure is fairly low. If we move to Bitcoin Galaxy and look for Sol, I think it's in lagging area, and it's at around the forward projection is negative 20%, composite risk is 0.43, and mean reversion pressure is also more or less the same for Sol. So these analysis can help identify what is again in the grander scheme of things, as ETH itself is in this lagging phase with respect to Bitcoin. Some of the cryptos are doing better than even ETH at this point, and again some cryptos such as for example Link is at a stable equilibrium with both Bitcoin and ETH on their Galaxy. If you want to look at both galaxies together, these are available in this dual galaxy mode over here. And also these assets again on this view, on this pair views are come with this description of the quantitative methodology used to create these opportunity return percentages, how this is calculated using the ARIMA models, and then composite risk scores using these multi SMA related interpretation, and also the probability estimates, the mean reversion probability estimate. What do they mean for bleeders? Again, mean reversion is a good thing for bleeders. That means mean reversion could help get back from that lower band to the middle band, whereas for rallying assets could be a mean reversion could be an unfavorable outcome. How is the distance from the core calculated with respect to this composite risk as well as mean reversion probability? Together, this distance from, let's say, focusing on Bitcoin Galaxy, the distance between Doge and Bitcoin is calculated based on this mathematical formula, and why these things are considered is also explained, and what these assessment zone or these color codes in detail are explained at the bottom. So you can check out all of them. These get updated every day, like all of the models, at least once a day. Coming to yet another interpretation of the value pairs is Bitcoin plus ETH, rather than comparing them against each other. What if they together, again, as they together control about 70-80% of the market cap? If we go over here and check what is the Bitcoin and ETH related market cap, again 1 trillion Bitcoin market cap, almost 200 billion ETH market cap. Of the total cryptocurrency market cap of 2 trillion, almost 1.4 trillion or more than that is almost 70% is covered by only Bitcoin and ETH. So together, their analysis is covered in this indicator section over here under peak value oscillation, to identify in a leading structural way if the asset class, thanks to Bitcoin and ETH, if they are only focusing on them, if they are entering into accumulation zone using leading indicators such as over here the drawdown from all-time high and 200-day simple moving average, to identify the variance between the price action and this, using that leading indicator to identify the euphoria tops as well as the immediate capitulation plunges, where typically the price goes the asset class goes into the accumulation territory. Right now it's in accumulation territory. Even the lagging the lagging indicators such as these basket of alpha beta Sharpe ratio and percent drawdown related and diminishing volatility accounting variables are also entering this lagging indicators are also coming closer to that accumulation zone. So that confluence also helps identify the relative market heat at any point. Also, with respect to this tree map over here, helps identify Bitcoin versus alt seasonality, what is the relative performance, and also Bitcoin composite risk, ETH composite risk with respect to this unified model that we have in this detailed view to identify the impact of regression risk, all-time high risk, time-weighted average price risk, and so on to come up with a composite risk score. It's available in the mathematical or risk gauge interpretation over at this indicator section, and also in this bubbles format to identify in a easier way across the asset class to identify with what is happening with respect to these USD levels for these assets. And they all tune into this crypto pair model to identify again the opportunity cost associated with again DCA into, let's say, Bitcoin or ETH versus some altcoin over here. Together, these metrics are pointing to again a bottom detector model over here is the composite risk of Bitcoin versus ETH accumulation is pointing to a closer bottom on both. The bottom model for both Bitcoin is at 0.23 and ETH is around 0.20. So anything at or near 0.20 is typically in accumulation territory. Bitcoin is just shy of that, whereas ETH right now, if we get rid of Bitcoin and Bitcoin's price action, we could see that ETH is coming really close to that accumulation territory like it came in February 2026 and in April 2025 territory. This is using 20-week simple moving average, and much more apart from that is again as this composite risk and the other indicator that we saw over here, the SMA bottoming indicator. What else can be analyzed is using this efficient frontier orbit to identify whether ETH has again and Bitcoin, if they are still in the gem category that is in this top left quadrant, which is typically the gem zone over here, or have they gone into that accumulation or safe haven territory. Right now ETH is in that safe haven territory, whereas Bitcoin is in this accumulation territory. This is calculated using again the using the volatility on the y-axis and the return on the volatility or risk is on the x-axis, and the return or the annual return is on the y-axis. The positive returning cryptos over here help identify again which are in this gem zone and help create that barrier between the or separation between the gem asset class versus high yielders, whereas the safe haven and the ones which are in danger zone. So this confluence and these analytical points are all available on this website. If you like this kind of a content, please give a like and subscribe, and check out all of these charts for your own analysis. Hope you enjoyed this content. If you did, please give a like and subscribe, and hope to see you again tomorrow. Thank you and have a nice day. Bye bye.